Stanford University.
We took it public in '99, was it?
About that, yeah.
Right at the peak. Ended up with a multi-billion-dollar market cap, so I assume that was nice for your limiteds and a little bit of carry left over. In that era, in the early '90s, they weren't very involved in the social mobile scene until they did this $12 million investment in this little teeny startup called Facebook. And at its peak, it was worth $10 billion. Your investment, that probably made some good multiples for your limited partners.
It was where do you measure the peak?
Yeah, okay. Yeah, you're right. It's peaked more than the peak now.
You held.
You held. That's right. I read it was only a few years ago you sold 17% of it. So
it's a good deal.
Yeah, and but they have in the last number of years. Remember, I talked about how the average returns in the last decade for VCs were way down in the single digits, and it's climbed up a little bit, and everybody targets to get up into the 20s, and they're at 30. So you want to be a limited in a company like that. When you have a 30% IRR, that really compounds very, very rapidly. So I hope Art's going to talk about how they've made these changes, what's been going on in the Valley, and what they're doing, but also we got to ask him about the Patterson cycle. So he has his own model that's widely quoted in the industry about the cycles of investment in these booms and busts. And I guess I'll turn it over to him. There's only one thing that we have to disclose. He got a BA and an MBA from Harvard, but we're not going to hold that against him. Thanks for coming today.
Thanks. Well, everyone can grow out of their sins, and I got out here full-time about 1980, so thank my lucky stars for that. I've always had a great fondness for Bill in particular because luck is an important part of this business, and that deal we were on together, Portal, paid back, it was a 1,000 to 1 shot, and paid back the fund that it was in 10 times on the fund that one deal. So the bubble is pretty good when it's going your way. And but I thought to get to know the audience, I might first ask, how many of you are here to be venture capitalists, and how many are you here to be entrepreneurs? And maybe we'll divide. So why don't we say venture capitalists first? Okay, so about, and then how about entrepreneurs? Okay, and then how about private equity? Smart. Okay, give that man, give big grade, good grade there. By far the smartest. I think really understanding the difference between the three categories of initiating venture capital, growth investing, and private equity are worthwhile because it turns out they're very different and they have different life and career paths, and so it's interesting. My understanding was you wanted to hear first about what's changed in the venture business over the years, and the bubble in particular. And the venture business really has the distinction of being although others claim it's actually the oldest business in the world. And from a first principles basis, somebody taking some initiative to package a service or a product and then offer it. Today you use the internet, and the poor guys who were doing it with a push cart didn't get quite as much leverage, but it's an inherently very simple business, and anybody that makes it too complicated isn't going to be too successful in it. When I got into the business, this might talk about location. I understand Bill Draper was here last week, and he talked about the birth of venture capital in Sand Hill Road and whatnot. Well, Bill, there was a time before for that, and all the great companies in America were started with a venture process. The venture business, when I got into it in the '60s, was mostly done out of New York. When I got into it in '71 for full time, probably 90% of the quote projects and deals were in Route 128 in Massachusetts, and that's the government put a bunch of money in a lot of the military-related companies there, so MIT and Lincoln Labs, and you had a very successful ecosystem there, or they thought it was successful then. And in California, all the technology was in Southern California in the aerospace businesses. There was really very little in Northern California, and so you could be very amateurish here. In New York, it was a bit more professional. The first institutional funds really got going in the late '60s, and there was a huge bubble market that looked like 99. In '69, you go back and read those prospectuses, they're just as crazed as anything you saw in '99. And it was the sort of early semiconductor bubble at the end of the long rise during the '60s. But there were firms like J.H. Whitney and Pace and Trask and others that had professional venture capital firms. They were out of New York. And so I went to work for Citicorp Venture Capital in '71, which had been started, and we were sort of a couple of years before, and we were sort of the index fund, because we were all young guys just learning of the venture business. And fortunately, they stuck with it. So from '69 to '69, they were up 50%. By '74, they were down about 50%. And by '78, when we all left to start our own funds, they'd compounded at 30% since '69. So, and it was a great place to learn. And that's the real trick in the venture business, is sort of getting your hands on somebody else's money to learn the business, because it's hard to do otherwise. It's I describe it, so it's a bit like business school, where you just go case study to case study to develop your instincts about it. And I'll come back to that. But today the location, we've seen it march down the valley, and now it's most of what we see is up in the city, and that's because. A lot of the most interesting things have been people keep moving toward the top of the stack that's open, and a lot of the digital media sat there, and a lot of that's been done in San Francisco. I think partly because macro media was there, partly because the entrepreneurs are younger and they like the urban lifestyle. But going back to the example of why it moved from the West Coast and Southern California up here, I think you got to look at the culture. And so I think you'd find cultural reasons that it has marched up the valley and ended up in San Francisco today. In terms of, well, why don't I open that to any questions there?
So I'm curious in terms of how the LP base has changed over time from when you first started getting investments from LPs early on at Accel, and how that's changed since then.
The LP base is just plain, more and more people have crept into it. I remember when we formed, I was at Citicorp till '78, and we formed something called Adler and Company, and some of the big potential investors were the bank. They have huge investment operations, and funds that they manage. So could they make an investment in venture capital? And anyway, there was a sort of conflict there, and we got the controller of the currency to write a letter to the banks that they could in fact invest. And so, you see a steady, inevitable progression toward a wider and wider ownership base. If they privatize Social Security, I'm sure we'll have the benefit of those funds too. But the thing about early stage venture capital is that there's really a very limited absorptive capacity. there aren't that many interesting companies. The best ones take a minimum amount of money. And if you're trying to do it with lots and lots of money, it usually ruins the project. And whereas something like growth equity can take quite a lot, maybe 10 times that, and private equity can take 2 orders of magnitude in terms. So that's why the choice of private equity is the right one, because there's just a lot more money to put to work there, and as long as fee structures remain, it'll do great. Any other questions about sort of location? No. Well, on the the future of venture capital, I think that people should take a supply side view of this, and if you've got a private equity firm, you got the entire New York Stock Exchange plus all the other companies as potential targets, and it's just a question of the pricing and the debt markets that you can do deals. And in growth equity, that ebbs and flows, but again, you have a very wide number of companies you could simply push capital into if that's what you're trying to do. In the case of early stage startups, no one who's in the business, no one knows how many deals they're going to do next year, or much less how many they'll do in the future, or what the opportunities hold. And it's just plain unpredictable, and it's because the underlying, what I think feeds the whole thing from a supply point of view is the productivity of the underlying technologies that on a secular basis keep stepping along. Semiconductors, fiber, software productivity, now maybe you've got cloud and things like mobile. They're all marching down very aggressive cost curves, and that enables the supply side. But if any of those curves flatten out or stop, then you basically won't have the creative destruction process, and your supply will dry up. So you could say it's a pretty good bet. On the other hand, all those things are sort of evident in the market right now, and maybe we've, for this cycle, had the major supply. That's what usually happens, is that you run through the supply. And any questions there?
I'd love to know more about the founding of Accel. And
Sure.
Can you talk a little bit specifically what was the strategy, what was the motivation, and how has it grown? And to your point, like, what is the future of it now that there's like a cost?
Sure. Jim Schwartz and I started it. We both got into venture capital at Citicorp Venture Capital, which is a place you could learn the business. And Citicorp Venture Capital, we in those days, you had to do a lot of different things. So we did things like Federal Express, we did private equity oriented things, growth things, medical deals, semiconductor deals. And we had a pretty fair representative of the whole market. And then as the business has scaled, you've had to specialize more and more. And so in '78, most of the guys that had been there for 8 to 10 years were able to start their own funds because the business picked up. I mean, in '74, I think only one new deal really was done, technology deal, Tandem Computer. But by '78, the business was very robust again. And so we formed a firm with a guy named Fred Adler in New York, and we did about 50 deals in the next 4 or 5 years. While at Citicorp, we were quite institutional. We wrote 50-page memorandum, but we thought about things a lot, and it was formal and good training. And at Adler and Company, we sort of did things, sort of startups, much more off the cuff, so it was really good training in doing startups. And then in '83, we were at one of these peaks in the market, which is when you can raise new venture funds. And so we did, and Jim Schwartz and I went off. The founder, Fred Adler, he was much older than we were, and we had different objectives. And so we formed Accel. And what we did when we formed Accel was we having been through 2 different firms before, we had a view on what led to what we wanted out of it, what led to longevity, and so we didn't name it Patterson Schwartz, which was the convention in those days. We called it Accel, and Accel, if you read music, you see Accel every now and then, and it means pick up the tempo, pick up the pace. And so we thought that was a good name, but we wanted a banner which other partners going forward would also like to participate in that wasn't personalized. And in those days, I say the business was much smaller than it is today, and so we did, and we had been doing medical deals, so we had, and it was sort of conventional that you did medical or healthcare and then information technology, and we stopped doing healthcare in about '96 when we really had to decide between one or the other, and it just the information technology is just it's just much the uptake is much better, and we made the right decision. So we added partners during that period of time. And you really want to add as many partners as you can train, and that's always been our view. And we give all the equity to the young guys, and then the senior guys could make money by co-investing, and that's a make the pie bigger as opposed to try to control as much of the pie as you can yourself, and that's been our philosophy, and that's worked for us. And so we've had, you could say a few generations. I think it was a continuum, but you could say we're on our third generation or fourth generation now, and it's been a great vehicle for a lot of people.
Do you think, so just to follow up, do you think that strategy is the key to the success of Accel? Or, I mean, is there something that makes you unique from other VCs, do you think, that has contributed to the growth and scale of it?
Well, I think every firm's different. Every group of founders is different. We had this blend of a lot of startup experience and a lot of quite good institutional investment training. And so if you compare it to, and we were coming from the East Coast, which is a more pulled together, whereas in Silicon Valley, as I think Bill Draper sort of conveyed, is everybody just, went out on the road and called on garages, and if you liked the guy, you gave him money, you gave him a little money, and there was no paperwork at all. And so we always had more of an investment approach as opposed, there's in the business, there's luck, there's initiative, and then there may be the opportunity to direct all that a little bit more. And we've always taken an approach directing a little more. So when we started Accel, we didn't do a lot of things, and we chose a couple of areas where we wanted to do more than other people. And it was harder for other firms that were already in the business then to make that kind of obvious adjustment because their partners were already spread amongst a fair number of companies and industries in their personal relationships. So we tried to stay and still try to stay a little bit more focused than the next guy. And that's the kind of, everybody's brochure in the venture business is pretty much you can, if the computer sorted the words, they're pretty much the same words. And so you can't tell much from that. But it turns out, in our view, that if you operate a little bit more professionally than other people over an extended period of time, the effects are quite significant. So we have our particular professional approach to it, and it's worked for us.
Given that backdrop of kind of several generations of Accel investors, as well as kind of the evolution of VC geographically and stage-wise, what's been the kind of role of the typical venture capitalist over time? How is that different from a venture capitalist today versus '96, let's say?
Well, different venture guys have very different skills and very different training, and that's much more important than the role you played, because the role is really the same in 1965 that it is today. And if a venture guy, ideally, the entrepreneur should understand his industry and his market in a vertical way better than anybody else. But the venture guy should be bringing horizontal best practices, views to that individual, and help that individual. I always say, you try to get them to do what's in their own self-interest, but it has to be their idea. And that it's back to this question of how much the business changed, and from a first principles basis, it really hasn't changed at all. So I'd say the most effective venture guys are the guys that are able to form really close partnership relationships with the entrepreneur, and help that guy avoid a lot of mistakes and reinforce his naturally good analytical judgment, get him to move a little bit faster. Ben Franklin had an expression, he was a smart guy, pain is instructive, and in the venture business, it's expensive. Pain. So we try to minimize the number of mistakes that these businesses that are all experiments are making to get them that much further along, that much faster. And the talent and abilities of venture guys to help in that, and their experience can have a big difference. But a heck of a lot of a lot of successful technology firms in California or the East Coast, I think if you go back and look at the story and really understand them, there's likely to be an invisible venture guy behind the entrepreneur who believed in him and believed in the project and did everything he could to make that person successful for an extended period of time. And that partnership, because most of these companies have fairly dark days along the way, and unless you have good backers, there are all sorts of reasons to head for the hills. So.
Can you talk about some of the expensive mistakes that in your partnership with Facebook and Mark Zuckerberg helped them avoid?
I'd like to say that. I'm not, I may have seen the deal to start with, but I wasn't the partner working on it. But I'd say there are in a portfolio, there'll be 5% or 10% of the companies where everything goes just like the Excel spreadsheet said it was going to go. And and really your role in those is to get out of the way, not give the guy every one of these entrepreneurs has 5 things he's got to get done. And if you add 3 more things because you're that much smarter, it's just going to confuse him. So we sort of say that the ones that are really going well, your objective is to just be supportive, help them get some more people, but your value add does come in say the 80% of the portfolio, which it's making progress, but it wasn't quite the way it was supposed to be, and it has to be repositioned. It's just taking time, and those are challenging. And there you do add an awful lot of help and value in terms of supporting the company and supporting it when it can't get any other money anywhere else and can't find or getting the right people to it. Those are the companies where the venture guys really help the most, and it's now you have to operate as if every company can be a winner in a portfolio, because you don't really have a clue, except for a few that Facebook was a success before we invested. The numbers were completely clear. In fact, they were so good that we missed a bunch of the messaging app companies afterward because they didn't look anywhere nearly as good. And but they had the statistics at that point in time that were just off the charts, and as a media property, their level of engagement with the initial students was, if you'd looked at media properties before, was so high that it was really phenomenal. And we paid a very big price to get in the thing. A lot of them are a lot of work and very dependent, as Bill I'm sure knows, that partnership can be, with the right venture guy, can be awfully important at various times. Yeah.
Can you talk about the biggest surprise where
you helped a company through one of those dark times, and then just like somehow it took off, and you're just like, wow, I was just doing my job, I was just trying to be supportive, and now it's $1 billion company.
Well, that's always what it's supposed to be like, you know. I mean, you never see a startup that doesn't look like it's going to be terrific, and so it's more that it doesn't take off than that it does. Now, even though it only does take off like that, quite like that, in 10% of the time, but yeah, the surprises are. So I'm not sure. Maybe I'm not answering your question.
You said that basically some of these just kind of go, and that's great. Facebook was already a success, but you gotta have a portfolio where some of them, you know, you're looking at your partners saying, you're just putting so much time into this company. Is this really a good use of your time? And is there any way they can ever build a business here? And then maybe you just stick with it. You help them, and then somehow they get to a point where it really, really, really succeeds.
Well, and that's the story of an awful lot of them. And I mean, we were very supportive of Facebook, and my partners on the deal. They helped recruit Sheryl Sandberg and a bunch of other key people, and didn't change direction. But you know, a lot of them, and probably 80% of them, have, you know, just don't go the way they're supposed to be going, and then. Some of them are going well enough, and if you're in a period like today where the financing is extremely aggressive, you frequently get the sort of problems financed away from you because people are very optimistic and they see the glass as half full and give you the benefit of the doubt. And so if you have a third-party financer coming in this sort of annual fundraising, then it's a lot easier to ride with it. And the hard ones are the follow-on financings where, oh, you know, the early returns are in, and it's just not looking quite right. And the Series B financings are the most difficult, because at a startup, everything looks perfect. Series B, there's real data on the table. It wasn't quite what the theory was, and those can be very difficult. And I think the real test of a venture firm is how they handle those, and which ones they back and which ones they don't. And different firms will have different approaches. Without naming any names, there are some firms that operate completely on the basis will be extremely aggressive going in. If you don't make your first quarters or whatnot, we'll stop funding you. And that works if you have a really great flow, and you're going to have some really in terms of your reputation, the flow. And then if you have some fabulous winners. If you don't necessarily have just those things for you, you better have better quality control at the front end of what you're doing, because you may have to back it for several times. And we've always been a persistent investment firm. I think any of the venture guys, any of the entrepreneurs involved with us will tell you that we stick in there longer than anybody, and it's worked for us because our bets were pretty well placed. And if we just waited and got the management, changed a little product positioning, waited for the market, some of them worked in a big way. And what you're talking about, an investment system, so it has to be coherent. The pieces have to fit together. Yeah.
And how do you analyze today's market through your theories of cycles? So where do you think we are in the cycle right now?
Well, no one knows where you are in these cycles, or if there even is a cycle, but there is an observable cycle of about 14 or 15 years. The peak in '69, there was a peak in '83, peak in '99, and it's usually been sort of 6 years down and about 8 or 9 years up. And then maybe the cycle, periodicity of the cycle is affected by other factors, maybe because the point is that you have the secular productivity factors underneath, but you have, on top of that, you have a financial cycle that's going up and down. And so we're about, depends on how you time life cycle, but we're about 8 or 9 years into the upcycle. And you can say, well, and it certainly has all the characteristics of the tops of the cycle, vast amounts of money available for anything that looks promising, great returns from everybody for the last 7 or 8 years. Looks like can't lose. I think, well, why would this cycle, be extended? I think the Fed gets a lot of credit. If, you probably would have done better in a lot of art or San Francisco houses than you would in the venture capital business, despite how well that's done. But all asset prices are pumped up enormously, and the amounts of money going into these later rounds is pretty staggering. But the companies are a good deal less speculative than they were in '99.
So you were talking about how supply drives the VC industry. Does supply also? Sure. Thanks. Does supply also? Do you think there's any historical correlation between supply and the cycle that you're talking about? That like maybe the supply is drying up and things have to look less promising and less innovative to get the money than maybe might be coming up after a downswing?
Well, I think that's right. What has happened in the past, in my view, is the secular technology productivity improvements are continuing sort of at 30% per year. And what that means is that after 6 or 7 years, you have about a 95% reduction in your cost of goods sold, as if it was oil. If the oil goes down by 95%, it's going to enable businesses that couldn't exist before. And so Facebook simply couldn't have been done before. And I think you look at all the winners in the cycles, you see that. And they tend to get started in about 6 or 7 years after the last peak, when the changes in the underlying technologies have basically obsoleted the last set of companies. They're not going to die, but it opens up a new resources for brand new companies and ideas, and then those companies tend to feed on each other and become platforms. So Facebook has been a platform for a large number of other social media companies that wouldn't have been possible without it. So today, do we have we sort of taken what we can out of these various supply factors, which produce all this productivity, and we're going to then need to wait some period of time for it to renew? I think there are certainly technologies that Google talks about, or you see being promoted a lot, that I think are next cycle technologies. They're just not going to be here, and the necessary conditions aren't going to be here. Closed loop robotics and 3D virtual reality and things like that. I don't think we're going to see them in this cycle.
So,
from a technology perspective,
in terms of advice for entrepreneurs, sometimes they hear mixed signals in terms of, should you raise as much as possible in the beginning or as little as possible? So as much as possible because you tend to underestimate your capital needs, and then you can go into a down cycle and kind of get screwed. The other side is, well, it's the most expensive piece of equity you're ever going to sell. And especially like in an angel round or something, by the time you get to a VC, you don't want to, quote unquote, screw up your cap table. So I was wondering if you had any thoughts on that, generally speaking.
Well, this is one of those questions of so specific to the circumstances and optimizing, particular circumstances. And you basically, as an entrepreneur, you want to use as small amount of capital as possible to accomplish as much as you can. And but different projects have different needs, and these angel rounds and the way they're mostly priced based on an unpriced round with some discount from the next round certainly encourages taking, from an entrepreneur's perspective, taking as much as they can get then, because then they can get hopefully far enough so that then when they do their Series A, it can be done at they can show enough that they can have a really nice markup and therefore keep a lot of the company themselves. And at this stage of the cycle, angel money is very aggressive, and entrepreneur, it's a seller's market from an entrepreneur's point of view, and very attractive for them. So they can and should get more. On the other hand, if you looked at philosophically, a lot of those may have been, when at the early stages of these companies, because they're experiments, unless you run a very tight experiment, you don't learn anything from it. So if you're lucky enough to get a lot of money, and there have been some examples of some gigantic seed deals, which have just produced chaos, so if it results in the thing becoming unfocused and you're not measuring what's working and what's not, then it can be very counterproductive. And there's certainly quite a few examples around the valley at the moment of that. But you're right, it always takes more time and more money, so get as much as you can.
So Draper was here last week, and he mentioned he studied history.
He said what?
He mentioned he studied history, and I heard you got a BA at Harvard. So I was wondering what you think allowed you to be a successful technology investor, despite not coming from a really technical background. Or I could be wrong about that.
Right. Well, it's a really good question, and I might talk about it in the context of the very different careers of early stage venture capital, growth investing, and private equity. And of the three, I think that the early stage venture capital probably requires the lowest IQ and the higher degree of balance and common sense. And to be really good and to have a career successful in venture capital, you got to be somebody that figures out who the smartest guy in the room is on any particular deal, as opposed to thinking you're the smartest guy. And the problem with a lot of really brilliant people in the business have had over time is they're used to being the smartest guy in the room, and they're used to making those decisions, and they don't have the objective of finding somebody smarter than they are. And I actually think history wasn't a bad thing to learn, because if you're looking to find the best entrepreneur in the business, it's like the horse bookie. He goes and he looks at all the records, which races have they won, and the genealogy, and who was the sire of the horse, and what. And in the case of entrepreneurs, you're looking at the backgrounds of these people, and were they in the right. Have they been the right guys in the right place to be exposed to the right ideas? Now, occasionally you get the things like a Facebook where there is no prehistory, and because they're sort of right on the edge of something new that's going to happen, so you can't be looking at that. But in that case, we find one of the interesting shifts in the business has been the shift toward so many of the digital media projects. And historically, the formula in venture capital was we were building faster, cheaper, better boxes and software that made things more efficient. And you could go to customers with direct sales force and explain it to them, and improve their business and increase their productivity, and it was valuable to them. And it was a rational process. And we almost always succeeded in developing the products. It varied as to how quick the uptake was, but it was pretty predictable. In the case of digital media, where it's a consumer product, there's very little capital up front, but what the uptake has been extremely hard to predict. And so we've sort of settled in it's sort of it's almost a kind of magic point. All the people that wrote messaging apps, which ones were going to take off, and so you can either invest with a really good team you like, and we did that with, say, a company like Slack, who actually changed direction, but we really like the team, or you can wait until you're lucky enough to intersect them when they're successful, after the sort of magic of the consumer uptake has occurred. I don't know if you've ever looked at the statistics on movies, but they know on the first day whether the movie's successful or not. And you have an industry, $100 billion industry putting out those movies, and they don't know what's going to happen the first day. So, there's and they've been at it for about 100 years. So, there's the digital media products have that characteristic that has changed because they became a big portion of the business. Has certainly changed the risk reward and the way you do the business, and would change this question of what do you look for in an entrepreneur. Yeah.
In your Harvard Business School keynote, you note that VCs are better off working with inexperienced entrepreneur management in fresh markets. What, in your view, are the advantages and disadvantages of working with inexperienced or first-time entrepreneurs?
Well, it's more the self-selection aspects of it. That if you could find a team to do a semiconductor project today that all had outstanding records. Educationally, they'd been at all the right companies, they'd been at it for, they're really hardcore professionals, they're 50 years old, and just best of breed. But the opportunities in the business are maybe almost non-existent today. And so that the younger guys that are operating at the highest levels of the stack, they have a more open opportunity. So if you get a really experienced guy, he's not as likely to be at the top of the stack. And that was the only point there. Now we're actually seeing some interesting things opening up at the bottom of the stack, because if you look around today, the companies that have survived 40 or 50 years are the semiconductor companies and the database companies. And neither of them were and they could always just keep everything in the middle has always gotten merged and absorbed, but if you're at the bottom of the stack, anyway, we're seeing some data asset companies that for the first time could be with using some of the new technologies be rebuilt and be better. And I don't. Semiconductors are harder. We dropped out of semiconductor investing in about '83. But we had some good ones. We had some good ones that are still public actually now. All right.
So Accel is a kind of a global investment company, right? There's a lot of other investment like in US and London and other places. So could you talk a little bit more on like the global investment and how do you look at the company?
Right. The way those funds operate is they operate very independently, and we found by experience that we were not able to be actively involved in the investments and investment policies of those firms and still have them be successful. You got to be too close to the ground, too close to the deals for it to work. So they're basically independent. And maybe we make a little carry out of them. Occasionally, in some cases, we do co-investments. We do co-investments with our European fund and our India fund. We've done some co-investments, particularly at a later stage. Sometimes in the our European fund does Israeli projects that want to become internationalized, and we'll put some money in alongside them too. But I'd say you get into what is the international representative? It's an expansion of the business, and people always want to expand, for better or worse, and that was an avenue we took to expand. It's very hard to, as we were talking before, the supply constraints in the new initiating venture business are so significant that you can't put that much money to work. So you can't really expand your US-based early stage venture activities that much, partly because you can't train enough people quickly enough to make the investments, partly because they leave when they become successful, partly because they don't work out. But that's a constraint there. So, but expanding internationally was a way to expand, and we had extra energy, so we expanded in those directions. And those funds have, they've done well in their areas. We try to have them have the same standards of practice that we do. And in some cases, we do all their accounting, and we try to have them follow the same model, but yet be independent in the markets.
So by like same standards, you mean it's more like operational standards instead of investment strategy, or like how do you look at companies and all that?
No, from an investment practice point of view, we'll try to have them using the same processes that we do. But the areas that are of greatest interest in India are going to be different so we're not going to be setting that back here.
So you mentioned earlier that the entrepreneurs should know the business vertically, and the best VCs know the horizontal landscape. It sounds like you acquired that skill set with your time at Citigroup. How do you develop that intuition or maybe that perspective in your junior partners at Accel, or do they already arrive with it?
Well, I think that that's a lot of people will say in the business, and I happen to believe it, that it's an apprenticeship business. It just takes a lot of experience. You got to look at you got to be through a lot of case studies, and in many cases you have to. I mean, a lot of these companies look absolutely hopeless at various points in time, and if you look at a startup, startups are very messy. And I think I put that in that speech, that it's not in private equity or even in growth investing. It's much more of an auction process, and the most optimistic guy wins the deal. In a startup, there's something wrong with there's lots of things wrong with it. The entrepreneur has a very mixed history. There are 5 things you can say positive about, 10 you can say negative about it. And so seeing the possibilities of this kind of messy situation, it takes a lot of experience. And similarly, things that if people don't have a lot of experience, it looks like a shiny new car and I can't wait to get in. And so you make a bunch of bad investments. But in terms of later, to your point about bringing a horizontal view to a company, I think that just, we have sizable portfolios, and we're all meeting regularly, and we're seeing lots of companies per week, as well as the ones that are in the portfolio. So we know what various companies are doing in how they're optimizing their sales and marketing and recruiting and those things. So it's partly, so a really young person in Accel he can pick up a lot of that. The more senior guys have more experience and would recognize it a little bit higher first principle basis. But a young guy can be better than somebody that's been in the business a long time if he just focuses on one particular area. He can be smarter and more knowledgeable and potentially have better instincts than a much more senior person.
So given today's landscape, are there any older gen tech companies that are ripe for disruption? Things that you see a bunch of new startups coming in starting to supplant these incumbents?
Oh, that's our business.
Any sub-verticals like database sort of technologies, publicly traded companies that, sort of have been there and just there are new startups coming out and they're going to take their market share pretty quickly?
Well, I think just so by definition, all the older companies just can't be innovative on these products, and we've just seen that over and over. I mean, that's the whole history of the venture business, is this creative destruction on, you look at Microsoft used to have more vans driving their in-house scholars around the campus than we had people in our companies. General Motors used to spend more on R&D than all of Silicon Valley put together. So it's the bigger companies, whether it's IBM or just they don't seem to be able to. It's just too hard a job for them to, because they always want to do something significant, and all these new things begin as really insignificant little things that are niches within it and sitting in the cracks between the big companies and plates, and then they turn out to grow to big things. But any of these big companies, they sit there in the whiteboard and say, what's the white space? You know, what are we? And they get McKinsey in and Bain and strategize, and then they do user conferences and talk to the users about, and most of the companies, and if you look historically at them, the reason they were successful is they built something when there was no market for it at all, and then as the market developed, they just happened to be the right guy in the right place. I mean, you have to look at individual situations. I mean, SaaS is different from digital media, but.
In your keynote, you note that a high percentage of VC companies are based on the SaaS model. As a result, VC portfolios have become stable, more and more stable over time. Do you see this trend continuing?
Well, SaaS, if in large part, if you look at what they're doing, it's taking over very well established functionality that they're doing in a better way, and so the actual risk in the project was really pretty minimal. And then it's a continuing revenue stream, and your relationship with the customers is a lot stronger. But and it's not as if we set out to do that. It's just fortunately the technology came along that permitted SaaS models, and and that's created a much more stable technology industry. And so I think that certainly software functionality is going to continue to move to SaaS models. So. Yeah. Sorry.
So in your keynote, you mentioned one of the difficulties of being a VC is needing to find the new thing, and a lot of these new things all look like green pastures. So my question is, how do you decide which of these pastures to really focus your energy and attention?
That's the hard part. Some people have an investment approach. They just go, if they really like the guy and they think the idea is original, that's the primary criteria. And we have to do that too. I mean, we have to do the new thing to be successful. But we try to take a little more of a top-down, well, that's really interesting, but it's not our area, and we've thought a lot about this other area, and we think we're a little bit ahead of the curve of other people in that area, whereas in that shiny car, that somebody else ought to know at least as much or more than we do about it. And so if you, so your portfolio over time, if you do everything that's really shiny, the portfolio will be completely incoherent. And there'll be there'll be very limited value add from the partnership to that portfolio because everything's totally different. And but that strategy can work if you've got really good guys picking the new thing, and they get the right ones. So it's luck and initiative. Just rely on luck and initiative, then those are two huge factors in the industry that can work.
As a follow-up question, which pastures are you currently bullish on? You yourself or Accel as a firm?
Well, I don't want to give you all of our secrets, but we think there's this area of looking at the databases again is quite promising. We think, but we're active participants in all the big data technologies and everything's happening in cloud, and we try to find areas within those which we think are the most promising. So, there'd be several people at Accel that think a lot about what's happening in big data and then which sections of that are the most interesting. And we're not trying to create whole new contrarian industries. We want to pick a few and then do a little more deeply in those.
When you talk about the apprenticeship of junior partners, how do you think of that in terms of compensation or carry? Do you give everyone the same carry, or do the senior guys have most of it?
Well, they have to earn it a bit, but they're overpaid from day one. That's no question about that. No, I mean we have everything's relative, and we have a very aggressive policy to get carry to people that join the firm as early as possible, and and it takes, in the early stage venture business, it takes a long time to see whether somebody's, quote, good at it if you're going to measure it quantitatively, because it just, it takes 5 to 7 years unless you really luck out to see whether your portfolio of companies is actually well selected and whether you've added the right value to them and managed it well. So we're giving them equity long before that quantitative measurement would be possible. But the people that are doing that are very experienced in the business. They've been through it all themselves. So it's up to them to recognize who's sort of on the path looking qualitatively rather than quantitatively. And so far we've been able to do that. Yeah.
What is Accel's viewpoint on competitive investments, that is investing in similar looking companies?
Excuse me?
What is Accel's viewpoint on competitive investments, that is investing in similar looking companies, and how do you evaluate competition in a landscape where companies are switching and pivoting so frequently?
So to restate, you're saying investing in competitive companies?
Yeah, similar looking companies. Yeah,
companies in the same space.
It's companies in the same space.
Companies in the same space.
Yeah, that's always a difficult question, because every entrepreneur worth his salt believes everybody else is competing with him, and it's sort of their instant reaction, and part of his vision, and that person's going to be in it. So, and they very, very seldom compete with each other or even ever see each other in the marketplace. The marketplace is very large, and it turns out if they know some particular thing, everybody's got their own angle of approaching the markets and things. So they're a good entrepreneur is always has a lot of paranoid characteristics, so that's really good, and so he worries a lot about that, and we try to avoid competitive investments, but on the other hand, we try to we won't make what we think is a directly competitive investment. Okay, say that unequivocally. But we frequently have to talk to entrepreneurs at some length about why this just isn't competitive with them. And sometimes we get calls, "Oh, you did a competitive investment," and then we have to go through that. But I've been involved with a lot of projects, and it's very, very unusual that they're, quote, competitive. It's almost hard for it to happen. And if you invested in Informix and Oracle, that might have been competitive, but it just very seldom happens. Yeah.
What's the most surprising thing you've learned in your career?
Surprising thing I learned. Well, human beings. I always say to my partners, if only we could build these companies without the humans. And the human and the human condition is so varied, and what growth path the individuals are, and which directions they take, and is where all the surprises come from, and the companies and the technologies kind of move kind of slowly, but the big surprises are usually around the people, and some of them are incredibly positive in terms of the growth and what they rise to. I mean, our approach tends to be that we get behind an entrepreneur and then we do everything we possibly can to make that guy successful by getting him around him. All the people, usually the entrepreneurs are not going to be great managers. That's hasn't been their background, particularly the younger guys. But that they're great visionaries, and that's the critical contribution. So we got to get around them, teams of people that have done it before in their particular areas, and keep that guy and the project moving forward. Every one of these companies has stories that you just wouldn't believe about, how bad things were and how they got solved. And I remember sitting in a board meeting once in a company called Veritas, and we'd started as Tolerant Systems, and this was about 1982, and it was basically an open system that competed against Tandem Computer, and we'd shipped about $100 million of them, and it worked, and it was great, but it was the hardware business was getting really tough. And we were getting down to about, I think we had $1 million in the bank, and we'd been through about 100 at that point. And we were sitting around the board meeting, and we figured we could finance the company. It made some progress, but we'd have to sell 100% of the company about 4 times, like Zero Must Tell, if you remember that movie. And he said, well, maybe we can make this a software company, and we've rewritten Unix to be a distributed architecture. Isn't there something in there that we can take forward as a independent software product? And we pulled out the file system, and we managed to get AT&T that controlled Unix International to make it the standard high-performance file system, and the company became worth $50 billion. So.
So Facebook basically was the biggest return for a VC in history, and it would seem to indicate
biggest
return for a VC?
dollar value, yeah.
Dollar value, yeah. And so it would seem to me that Accel is pretty set for the next 10, 20 years probably. But I'm just curious, what do you see as threats to Accel and in the industry as a whole? You kind of mentioned that there's huge seed rounds now. There's regulatory issues, right? There's less IPOs going. Like, what keeps you up at night, essentially?
Well, I don't stay up at night that much anymore. but venture firms, like investment firms, actually have extremely strong franchises. They're hard to create, takes a lot of time, and they're extremely strong. But if you look, there's a lot of turnover in investment firms, hedge funds, and venture firms aren't that different. They may be a little stickier because of the long time that the commitments are made. The funds are put in for 10 years or more. And a hedge fund, you can pull it out that month. But if you let the quality of the people run down in the firm, and they stop working hard and paying attention, and then it's like a clock. The spring just winds down, and we've certainly seen turnover in firms, and they have to be renewed constantly with more better people, and so my younger partners worry about that. Fortunately, I don't have to worry about it much because they've got to find peers of their own but if they do that, and the supply factors we were talking about before are sustained, then it's going to be a great business to participate in, and we'll get our share of it.
So just to follow up, so like different models of VC, like Y Combinator or Andreessen's model, or crowdsourcing, those type of things don't really worry you, or the IPO market, like those aren't. It's mainly people, is what I'm hearing.
Well, Y Combinator is I'd put them in the. They make a great contribution. They're great people, and we've funded quite a few Y Combinator companies. From our point of view, not enough can be done by angels and to bring these ideas forward and fund them at early stages, and And so we view them as Y Combinator and LD Angels as complementary to our processes. And Andreessen has a particular spin on the business, which has both a substantive and a marketing and sales perspective. And the reasons it does work with some entrepreneurs, the reason it doesn't work with some entrepreneurs. So, but it's a big, it's a big market. I mean, I'm going to criticize their model because their model works for them in their context.
The dot-com bubble seems crazy. I'm curious if it was fun. Like, did you have fun investing in the dot-com bubble for a little bit?
Did we have funds investing in the dot-com?
Fun. Good time. It was enjoyable. It was a good time.
Well, it was a lot better than 2001 and 2003, where it was actually attrition and tierage. Some of the deals that the thing that's never happened in the business before that happened then was that some of the companies that were funded, say around 2000, and they had big fundings, and 6 months later, the investors said, "This is a terrible idea. We want the remaining cash back," and the companies were liquidated because the idea in that short a period of time, as things rolled over, an idea that seemed very sensible just seemed crazy, and normally all these companies that get funded basically run their capital right out to the bottom. So that was the only time that things were done in such a way that and then the shift was so sudden that a lot of the ideas just made no sense at all. Yes.
So there was a dramatic decrease in investment in clean tech. Where do you see that going in the next few years / 20 years down the line? Is there room for clean tech in the VC space?
Well, I think I said in those remarks, we're hopeful that maybe this next generation there'll be another generation of products around it which are less commoditized, and where the uptake by the customers will be a little bit faster. And whether we were conservative, we missed it because we were conservative, or we missed it because we thought we'd seen that before. But look at how much the power density of batteries has changed in the last 10 years versus how much productivity we've got out of semiconductors in the last 10 years. It's like, and so materials technologies, chemicals, things like that, they just don't have productivity curves. And if you look at the biologics business, the 10 years and $1.5 billion to get a new drug out, that was true in 1995, and it really ruined the business for the next 20 years. And so, some of these factors are pretty durable. And I know we made one smart grid investment. We made one. We in the. I think we have a company that participates in the financial side of the of solar on residential, and which looked to us like an area that might be profitable. So, and we hope there'll be something. God knows we need productivity in those areas. We need new energy sources and whatnot. But if you look at the long curves on replacement of fossil fuels, it's not happening very quickly, despite huge government subsidies. And you're individuals, and you got your lifetime frame as individuals versus the technologies, and sometimes the two don't match up very well.
So I'm going to ask a final question in terms of, so you started off your presentation in which you realized about a third of the class is interested in pursuing venture capital afterwards, and then 2/3 of the class is interested in becoming an entrepreneur. What do you have as advice for both of those groups? And then we have one PE person. Should we all follow him, or any general advice for them?
Well, so it's the advice to.
So advice for the VCs, advice for the entrepreneurs.
Those interested in being VCs, advice for those interested in becoming entrepreneurs.
Well, there are sort of two paths into VC, and one is the growth stage investing. And a lot of the venture firms have growth funds, and they hire people out of college, and then they try to find a lot of, that's mostly out calling to find growth deals. And then, but most of the guys that get into the venture, into the early stage venture side, tend to be somewhat older. They may go to business school, they've worked in a company, and they're sort of 32 instead of 22. And that's the early stage venture business. Sometimes guys go from the growth, maybe they're going to go to business school, maybe they get into the early stage venture side. And both can be pretty interesting. The relationship you have with the companies as a early stage venture person is completely different than the growth investing, because you have a very close, you don't invest very much money compared to the growth stage, but you have a close relationship and you have to make a big multiple on whatever you do invest. But you've got to get satisfaction out of having that relationship with the entrepreneur, because the growth investor, you're putting in $3 million, the growth investor is putting in 50, and if he makes 2 times, that's 100. You've got to make 30 times on your 3. So, so you got to enjoy working, and in growth investing, the money's primarily made at the time of the deal. It's like private equity in that respect. Whereas in venture investment, you're going to work hard on this thing for 5, 8 more years to make money, and you've got to enjoy doing that. And some personalities would be much better entrepreneurs than they would venture guys. In the venture business, you always have to make the idea the entrepreneurs, or it's simply not going to get done. So it doesn't make any difference how smart you are in that board meeting and telling him what to do. If he doesn't adopt it as his idea, it's not going to happen. So you're never going to participate in the leading of the team and successes that entrepreneurial leader is going to. And that's, for some people, a very important psychological aspect of what they enjoy working at. And so the venture guys are going to sort of work away in the background. They're only going to have financial rewards over long periods of time. It depends on the external cycle, but historically, you'd have 3 great years and 12 bad years. So, and then you got to work away in the companies all that time without actually getting any positive financial reinforcement. Growth isn't as true, and of course private equity is quite different, where you're very involved in the companies there, but it's much more hierarchical, much more process. You're shutting down things and reshaping things rather than new things. And so advice to entrepreneurs, I think get as much money as you can. It's going to take longer and cost more than you thought. And find a good venture guy. I mean, the question every entrepreneur should ask the venture guys: is this guy going to make me more money than the next guy because of his background, his record, his patience, is what other entrepreneurs who've worked with him say, and is the firm going to be able to bring resources that help him? He's going to choose a partner that he's going to. It's a lot easier to change the entire rest of your management team that is your venture guy. So you want to choose somebody that you think it's going to be sticking with you. Now, if everything goes well, you won't notice him. He'll go work on his other problems, but the odds are there'll be a lot of missteps or hesitating steps along the way.
So I guess the final question is actually, is there anything you wanted to cover that we didn't give you a chance to cover?
I'm really at your disposal, you know.
Okay, well,
For more, please visit us at stanford.edu.